Preparing for NRG Energy FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join NRG Energy in FP&A. I have built my experience around financial analysis, forecasting, and communicating insights to business partners. FP&A appeals to me because it combines detailed modeling with decisions that affect performance. NRG is especially interesting because its power generation, retail energy, and customer solution businesses create meaningful operational complexity. I would bring strong Excel skills, curiosity, and disciplined follow-through, while learning the commercial drivers behind demand, pricing, fuel costs, and customer retention. My goal is to become a trusted partner, not simply a report producer. While answering, connect your finance, analytical, and communication experience to FP&A responsibilities, demonstrate interest in energy markets and customer solutions, and explain why NRG's scale, transformation, and operating complexity are attractive. Question 2. What do you understand about NRG Energy's business model? NRG operates across power generation, electricity and natural gas retailing, and customer-focused energy solutions. Its results depend on both contracted and market-based economics, including customer usage, pricing, power prices, fuel costs, plant availability, weather, and hedging. From an FP&A perspective, I would translate those operating drivers into revenue, margin, EBITDA, cash flow, and risk expectations. Understanding how commercial decisions and physical operations interact is essential for producing forecasts that management can actually use. Make sure to cover NRG's integrated energy activities, including power generation, electricity and natural gas retailing, customer solutions, market exposure, and how operating and commodity dynamics flow into financial performance. Question 3. How would you build an annual budget for an energy business? I would begin with a calendar and clear ownership for each assumption. Then I would model revenue by customer volume, pricing, churn, generation output, and market conditions, followed by fuel, purchased power, payroll, maintenance, technology, and other operating costs. I would separately incorporate capital expenditures, working capital, financing items, and cash timing. After reviewing submissions with operational leaders, I would challenge inconsistencies, reconcile to strategic targets, document assumptions, and establish monthly variance thresholds before final approval. In your answer, discuss collecting business assumptions, modeling volume and price drivers, incorporating operating costs and capital spending, validating departmental submissions, documenting assumptions, and establishing monthly variance review responsibilities. Question 4. How do you forecast revenue for an electricity retailer? I would forecast revenue using a driver-based model rather than applying a simple growth percentage. Key inputs include customer counts, acquisitions, churn, average usage, weather, rate plans, geographic mix, and expected price realization. I would separate volume changes from price changes and consider how hedges or contracted supply affect economics. Historical data provides a starting point, but commercial teams should validate assumptions around promotions, retention, and market conditions. I would then compare actual customer and usage trends monthly. Be sure to mention customer counts, acquisition, churn, usage patterns, weather, rate structures, price realization, geographic mix, hedging, and reconciliation of forecast assumptions to historical trends and commercial plans. Question 5. How would you forecast power generation revenue and gross margin? I would forecast generation using expected dispatch, capacity factors, availability, planned outages, and market conditions. Revenue would reflect power prices, contracted volumes, ancillary services, and other market products. Gross margin would then incorporate fuel consumption, heat rates, emissions costs, purchased power, and hedge settlements. I would separate operational assumptions from market price assumptions so sensitivity analysis is transparent. Actual results should be reviewed against both volume and spread drivers, because a revenue variance may not equal a margin variance. Focus on generation volumes, dispatch, capacity factors, power and fuel prices, heat rates, outages, ancillary revenues, hedging, contract terms, and the distinction between accounting revenue and economic margin. Question 6. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial target for a defined period and provides accountability for spending and performance. A forecast is management's current best estimate of what will happen, so it changes as new information emerges. A long-range plan typically covers several years and connects strategic choices, investments, market assumptions, and capital needs. In FP&A, I would preserve the original budget for variance analysis while updating the forecast objectively and explaining why expectations changed. In your answer, distinguish the budget as an approved operating target, the forecast as an updated outlook, and the long-range plan as a strategic multi-year view, including their different purposes and update frequencies. Question 7. How do you perform a monthly actual versus budget variance analysis? I start by validating that actuals, budget, and prior forecast use consistent definitions and periods. I then identify material variances and decompose them into volume, price, mix, timing, market, operational, and one-time effects. After discussing root causes with business owners, I determine whether the issue is isolated or changes the outlook. My report would highlight the financial impact, explanation, owner, and action required. I would also update the forecast when evidence indicates a recurring trend. Make sure to cover data validation, materiality thresholds, price-volume mix analysis, timing and one-time items, root cause discussions with owners, forecast implications, and concise communication of actions to management. Question 8. What key performance indicators would you monitor at NRG? I would tailor KPIs to each business, but important measures could include customer additions, churn, retention, usage, revenue per customer, gross margin, and EBITDA for retail operations. Generation metrics could include output, availability, capacity factor, heat rate, outage days, and realized power spreads. At the enterprise level, I would monitor operating cash flow, capital spending, free cash flow, leverage, and forecast accuracy. I would avoid reporting metrics without context, linking each KPI to a financial outcome or management decision. Discuss KPIs relevant to retail and generation, such as customer additions, churn, usage, gross margin, EBITDA, availability, generation, heat rate, outage rates, cash flow, and safety or service measures. Question 9. How do weather and seasonality affect an energy forecast? Weather affects both customer consumption and market economics. Hot summers can increase cooling demand, retail usage, and power prices, while mild conditions may reduce volumes and generation dispatch. I would use historical heating and cooling degree days, regional exposure, and current weather outlooks to create a normalized base case. Because forecasts are uncertain, I would add upside and downside scenarios for extreme conditions. I would also distinguish customer volume impacts from price and margin impacts when explaining the result. Be sure to mention heating and cooling demand, regional exposure, degree days, customer usage, power prices, generation dispatch, historical normalization, and scenario analysis for extreme weather outcomes. Question 10. How would you model the impact of higher natural gas prices? I would first identify where gas is consumed and whether costs are fixed, indexed, hedged, or passed through to customers. Higher gas prices may increase generation costs, but they can also raise power prices and alter dispatch economics. I would model the net impact by asset, customer portfolio, hedge position, and contract structure. The analysis should include EBITDA, cash flow, working capital, and liquidity effects. I would present sensitivities around the price assumption and clearly state timing and hedge limitations. Focus on direct fuel cost effects, dispatch economics, power price correlation, retail procurement, hedges, contractual pass-through, margin compression, cash impacts, and sensitivity ranges rather than assuming a single static outcome. Question 11. What is working capital, and why does it matter in energy FP&A? Working capital represents operating assets and liabilities that affect cash timing, including receivables, payables, collateral, inventory, and settlement balances. In energy, timing can be especially important because commodity prices, customer billing cycles, and market settlements may create large temporary cash movements. A business can report solid EBITDA while experiencing cash pressure if receivables grow or collateral requirements rise. I would forecast balances by operational driver, monitor aging and settlement timing, and connect changes to liquidity and free cash flow. In your answer, explain receivables, payables, collateral, inventory, deposits, settlement timing, billing cycles, and why working capital directly affects liquidity and free cash flow despite not always changing EBITDA. Question 12. How would you analyze a capital expenditure request for a power asset or technology project? I would begin by clarifying the project's purpose, such as reliability, compliance, growth, cost reduction, or technology enablement. Then I would estimate timing, incremental revenue or savings, operating costs, maintenance, tax effects, working capital, and residual value. I would evaluate NPV, IRR, payback, and cash flow timing under base, downside, and upside cases. Finally, I would identify execution risks and define post-investment KPIs so actual benefits can be compared with the original approval case. Make sure to cover strategic rationale, operational benefits, project timing, construction risk, incremental revenue or savings, maintenance implications, NPV, IRR, payback, sensitivity analysis, and post-investment performance tracking. Question 13. Explain EBITDA, free cash flow, and why both matter to management. EBITDA measures operating performance before interest, taxes, depreciation, and amortization, making it useful for comparing operating trends and leverage. Free cash flow goes further by reflecting cash taxes, interest, working capital movements, and capital expenditures. Both matter because EBITDA shows earning power, while free cash flow indicates financial flexibility for debt reduction, investment, or shareholder returns. I would never treat EBITDA as cash, especially in an energy business where capital requirements, collateral, and commodity settlements can materially affect liquidity. Discuss EBITDA as an operating performance measure. Free cash flow is cash available after operating needs and capital investment, and the effects of working capital, taxes, interest, and capital intensity. Question 14. How would you evaluate forecast accuracy? I would measure accuracy by comparing actual results with the budget and each prior forecast, using both absolute error and directional bias. I would analyze revenue, margin, expenses, cash flow, and major operational drivers separately, distinguishing controllable execution from market or weather movements. Repeated misses may indicate weak assumptions, timing issues, or poor communication. The purpose is improvement, not blame. I would document lessons learned, update driver logic, and monitor whether forecast changes reduce recurring errors. Focus on measuring actuals against budget and prior forecasts, separating controllable misses from market movements, tracking bias and error by driver, identifying root causes, and improving assumptions without manipulating the forecast. Question 15. Describe a time you found an error in a financial model or report. In a monthly reporting file, I noticed that a department's expense trend was unusually favorable. I traced the variance to a formula that excluded 1 month from the comparison range. I reconciled the model to the general ledger, quantified the correction, informed my manager before distribution, and updated the report. I also added a check comparing period counts and totals against the source data. The experience reinforced that reasonableness testing and independent reconciliations are essential, even when formulas appear complete. In your answer, use a clear situation action result structure, explain the control or reconciliation that exposed the issue, quantify the impact if possible, communicate promptly, and describe the permanent prevention step. Question 16. How do you ensure data integrity when combining ERP, operational, and commercial data? I would establish a clear source for each data element and confirm definitions, units, time periods, and organizational mappings before building the analysis. Financial totals should reconcile to the general ledger or approved reporting system, while operational metrics should reconcile to their accountable owners. I would use automated checks for missing values, duplicates, unusual movements, and period mismatches. Version control and documented transformations are important, especially when files pass between teams. Before distribution, I would perform an independent reasonableness review. Be sure to cover source ownership, consistent definitions, period and unit checks, reconciliations to the general ledger, exception reports, version control, documentation, and review procedures before distributing outputs. Question 17. How would you explain a complex variance to a non-finance executive? I would lead with the conclusion and quantify the result in business terms. For example, I might say EBITDA was below plan by $8 million, primarily because warmer weather reduced customer usage by a defined amount, partly offset by favorable pricing. I would separate temporary effects from structural issues, avoid unnecessary accounting language, and show the bridge visually. I would finish with the forecast implication, management action, and any decision needed. Effective communication makes analysis useful rather than merely accurate. Discuss leading with the conclusion, translating financial results into operational drivers, quantifying the effect, separating temporary from structural factors, using simple visuals, and ending with implications and recommended actions. Question 18. What Excel or financial modeling techniques do you use most often? I use structured assumptions, driver-based calculations, SUMIFs, XLOOKUP, pivot tables, scenario switches, and sensitivity tables frequently. I separate inputs, calculations, outputs, and checks so another analyst can follow the model quickly. I avoid hard-coding in formulas, use consistent sign conventions, and add reconciliations to source totals. For larger workbooks, I limit unnecessary complexity and document key assumptions. The objective is not impressive formatting, it is a model that is accurate, flexible, transparent, and easy to review. Mention structured assumptions, driver-based formulas, XLOOKUP or index match, SUMIFs, pivot tables, scenario switches, sensitivity tables, error checks, clean formatting, and avoiding hard-coded values in calculation areas. Question 19. How would you use SQL, Power BI, or other tools in an FP&A role? I would use SQL to extract and join validated datasets, then use Power BI or similar tools to present recurring KPIs, trends, and variance drill downs. Automation can reduce manual copying, improve consistency, and make reporting available sooner. However, tools do not replace finance judgment. I would validate source logic, reconcile key outputs, document refresh steps, and ensure users understand definitions. My aim would be to move time away from repetitive preparation and toward explaining drivers and supporting decisions. In your answer, emphasize using tools to automate recurring reporting, standardize data, enable drill-down analysis, improve controls, and preserve finance judgment rather than replacing business understanding. Question 20. Tell me about a time you managed competing deadlines. During a reporting cycle, I had a forecast update, a management presentation, and an ad hoc analysis due within the same week. I ranked them by decision deadline and business impact, confirmed expectations with stakeholders, and created a short work plan with dependencies. I completed the forecast foundation first, reused validated outputs for the presentation, and communicated a realistic delivery time for the ad hoc request. Everything was delivered on schedule, and the process showed me that early alignment prevents avoidable last-minute pressure. Make sure to describe prioritization based on business impact and deadlines, early communication, dependency management, quality controls, delegation where appropriate, and the specific result achieved. Question 21. How would you handle a business partner who disagrees with your forecast assumption? I would first understand the partner's operational evidence and clarify exactly which assumption differs. I would compare both views with historical results, customer or market data, contractual information, and current business plans. If uncertainty remains, I would model a base case and relevant sensitivities rather than forcing false precision. I would document the agreed assumption and its owner, explain the financial impact, and escalate only when the disagreement materially affects a decision or lacks an accountable resolution. Focus on listening to the operational rationale, clarifying definitions, testing assumptions against evidence, using scenarios when uncertainty remains, documenting ownership, and escalating only after constructive resolution attempts. Question 22. What controls are important in the FP&A forecast and reporting process? Important controls include standardized templates, controlled access, approved assumptions, version naming, source-to-report reconciliations, formula checks, and documented review sign-offs. I would maintain a clear audit trail for material changes and separate preparation from approval where practical. Reports should include checks for completeness, unusual movements, and consistency with the general ledger. Strong controls should support speed rather than create unnecessary bureaucracy. They reduce the risk of distributing an inaccurate forecast and make management reporting more credible. Discuss access control, standardized templates, assumption approval, source-to-report reconciliations, formula checks, version control, review sign-offs, change logs, deadline discipline, and segregation between preparation and approval. Question 23. How would you build a scenario analysis for NRG's outlook? I would identify the assumptions with the greatest earnings and cash flow sensitivity, such as power prices, gas prices, weather, customer demand, churn, outages, and hedge coverage. I would build a transparent base case plus upside and downside scenarios, changing linked drivers consistently rather than applying arbitrary percentages. Each scenario would show revenue, margin, EBITDA, cash flow, capital spending, and liquidity effects. I would also define trigger points and management actions, making the analysis useful for planning rather than merely descriptive. Be sure to cover key uncertainties such as power and gas prices, weather, customer demand, churn, outages, hedges, capital spending, and liquidity, while defining clear assumptions and management triggers. Question 24. What questions would you ask your manager during your first 90 days at NRG? I would ask which decisions the team most needs to support, which deliverables are most critical, and how success will be measured. I would learn the reporting calendar, forecast ownership, key stakeholders, system architecture, and definitions behind major KPIs. I would also ask where current processes create delays or recurring errors. My first priority would be producing reliable work and understanding the business. After that, I would suggest practical improvements, such as automation or clearer driver-based reporting. In your answer, address priorities, reporting cadence, key stakeholders, business drivers, forecast ownership, system architecture, recurring pain points, success measures, and opportunities to improve reporting or automation. Question 25. Why should we hire you for this FP&A analyst position? You should hire me because I combine analytical discipline with a practical, collaborative approach. I can build and audit models, investigate variances, automate repetitive reporting, and communicate conclusions clearly to non-finance partners. I am also motivated to understand the operational drivers behind energy results, including demand, pricing, generation, fuel, and customer behavior. I take ownership of deadlines, question assumptions constructively, and learn quickly. At NRG, I would aim to deliver accurate analysis that improves forecasts and supports better decisions. Make sure to summarize analytical capability, attention to detail, communication, ownership, technology skills, energy industry curiosity, adaptability, and the specific value you can provide to NRG's finance and operating teams. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.